All right, it says we're live.
Great.
So good. I can see people starting to trickle in here. So I'm going to play the intro, and then we'll come back and we'll have our chat.
Great.
I'm David C. Barnett, and you're tuned in to Small Business and Deal Making, the podcast, YouTube channel, and blog where I talk about buying, selling, financing, and managing small and medium-sized businesses while controlling risk. So if you're looking to take control of your future through buying a business one day, or if you already own a business and you're looking to grow or exit, you've come to the right place. I talk about interesting things, I talk to interesting people, and I answer your questions every week right here. So be sure to hit like and be sure to hit subscribe, and let's get to it. Are you thinking of growing your business or beginning a journey into entrepreneurship? Take a shortcut to success by buying an existing and profitable business the right way. Visit businessbuyeradvantage.com and learn more about my online training, group coaching, and consulting services designed to help you win.
All right, everyone. Today we've got a very special guest. We have Jon Shell, who's tuning in today from Toronto. We're going to be talking about some new law in Canada that is going to be covering something called employee ownership trusts. And even if you're not in Canada, if you own a business and you want to exit one day, or you work in a business that you may want to take over, stay tuned in, because these rules are based to a certain extent on legislation that already exists in other countries, the UK, the US. And so some of the concepts and conversations we're going to be having here today are equally applicable in other countries. So, Jon, I'd like to kick things off by just having you give us a quick introduction. Who are you? Give us a bit of your background and the organizations that you're working with today.
Thanks, David. Nice to be on with your guests and yourself. My name is Jon Shell. I'm chair of Social Capital Partners. SCP is a nonprofit based here in Toronto. Our objective is to make it easier for more people to own things in the economy, be it businesses or houses or other assets. You know, we come at this from the perspective of wealth inequality, where so many of our assets are being concentrated in so few hands. So we come up with ideas to try to spread out and find opportunities for other people to own assets. My background is pretty much entirely in the private sector before I got to SCP about 7 years ago, and in things like roll-ups and consulting and what have you. And we may get into that over the course of this conversation. But, you know, I had a view in 2016 that the work that I had done and the things I had been involved with were leading to a more unequal world where, you know, companies and service and industries and service to clients were worse, and felt the need to try to find different ways to organize our economy. And that's how I got to employee ownership and to Social Capital Partners.
Okay, and so today, would you say that your organization is involved in creating like education, or do you like lobby
No.
for change in
Yeah.
government, or how do you act?
Yeah. So we are now almost entirely focused on public policy, right? That's not where we were. Our background is more impact investing, and we have shifted over the last 5 years or so to more of a public policy focus. Our view has been that there's just more opportunity to create real change through changes in laws.
Okay. And so can you tell us a little bit about the evolution or the pursuit of these new employee ownership trust rules in Canada?
Yeah, I mean, look, so when we started looking at, you know, what were the different ways in which we could shift ownership in the economy, we looked around, right? So what are other countries doing? I mean, we're based here in Canada, but we've invested in the US, and so what are other countries doing? And that led us to the American ESOP, which is their version of the employee ownership trust. And it was started in the mid 70s, so it's been around for about 50 years. And at this stage, there's over 6,000 companies in the US that are owned by their workers through these ESOPs. And the way it works is there are significant tax incentives for business owners to sell to an ESOP, right? So it's a leveraged transaction where the vendor, the owner of the company, is financing part of it. A bank might be financing part of it. But in the result, in the end, this trust, this ESOP, will then own the business on behalf of the workers. And it's produced like ridiculous outcomes in the US, right? So these 6,000 companies are owned by something like 14 million American workers who hold $2.1 trillion in wealth in these companies. So, $140,000 or so per person, which, there are very few programs in world history that has created that much value for, regular people, right? And in the course of our yeah, please.
So like in a large publicly traded company, for example, a company could have some kind of program that allows employees to buy stock. And so they
Yeah.
become owners and they can start to participate in the prospects of the enterprise. But what these programs do, like the ESOP, is they actually bring this down, sort of down market into the world of smaller businesses. Is that what you're saying?
Well, there are small businesses and there are large businesses. So the thing that makes these trusts different from stock option plans or share purchase plans is you're often seeing a majority of the company owned by the trust at the end of the day.
Okay.
But the others are mostly around minority investment. The second thing that makes it really important is the workers themselves do not pay for their benefits, right? Because these are leveraged transactions, there's no equity requirement. And that broadens access to all of the company's workers as opposed to just management or a few wealthier employees. And so,
Okay.
yeah, go ahead. Yeah.
So maybe this would be an appropriate time to have you walk us through sort of a sample scenario. Could you describe a business and its owner and what the sort of steps might look like in using one of these trusts to convey ownership?
Yeah. So just very briefly before I get to that, I'll say that, these things also now exist in the UK. They've been there 10 years. There's now 300 companies a year that sell to their workers. And that's what drove us to advocate for them in Canada. And so now they exist here in Canada. So I'll take a Canadian example, right? So I assume the audience, I don't know where the audience comes from, but let's assume it's Canadian for now.
All
so
over.
Yeah. Okay. So assuming it's a Canadian company and it's worth, say, $10 million. Okay. So the owner says, and that's the fair market value. So they've gone to their accountant and said, what's my company worth? Well, if you're putting on the market, it's about $10 million. So the owner says, all right, well, I don't want to sell to an outsider. And normally it is an owner who is very protective of the company's legacy, their employees, the community. They say, I don't want to sell to an outsider. I'm worried about what will happen. I'm going to try to use this trust instead. So the simplest version is they say, I am going to sell the shares of this company to this new employee ownership trust that I've created. Okay. And then the company is going to pay me the fair market value over time. So the company now owes me $10 million in exchange for these shares. So future company.
Does the trust owe him the money because the trust purchased the shares?
So to go through the mechanics, the trust will likely start a new co, a purchaser co. Okay. Right. The shares are then sold to the purchaser co.
And they merge them after.
For them, and then they merge it with the company. The EOT is then the 100% owner of the company that now holds the debt, right? That's owed back to the owner. So that's the technical. This is like, it uses a traditional private equity style NewCo OpCo structure. So once that transaction's done, the trust now owns 100% of the shares of the company. It doesn't have to be 100%, but in this example, it is. And the company itself owes the owner $10 million. Now, this for lots of folks would seem pretty risky. Right? Instead of selling a company to an outsider, like a private equity fund or a competitor, I've sold it to my employees and now I get paid over the long term. There's a lot more risk to that. And so in order to account for that, what the Canadian government has done, which is similar to what's been done in the UK and the US, is they provided a tax incentive. So the $10 million is, so in Canada, up to $10 million of capital gains in one of these sales is tax-free. So that $10 million that I get, I pay no capital gains on the proceeds. And that's the thing that might encourage someone to be okay with the fact that they're not getting all their money up front.
Okay. And so there's a tax incentive to encourage people to do it. And I guess if the person even didn't collect everything on that capital gain, would that tax benefit be of use to them in some other way if they had other investment gains or something like that?
No, it's only tied to
it's been isolated to that one thing.
Yeah, that's right. Yeah, like so when you're filling out your tax forms, you're going to say I sold my company for $10 million, and I'm going to use my $10 million capital gains exemption, and now I don't owe any capital gains tax. Whether or not you get paid that money over time, that's a loan now, right? So that's an entirely separate issue.
So we talk a lot about seller financing on this channel, and I talk a lot about the advantages for buyers in that it keeps sellers engaged, it maintains access to sellers. Sellers have a real vested interest in the success of the business after the sale because they want to ultimately collect all the money that's owed to them. So, I mean, what have you seen? Like, are there many of these things that have been enacted yet in Canada under the new rules?
No. So the new rules are too new for there to have been any, right? I mean, these
Okay.
transactions take time. So the rules were established at the very end of June 2024. So
Okay.
I believe the first EOTs are going to close around January 1st, and then there'll be a bunch next year. But I have lots of experience with this in the US. And there, there's, so first of all, the depending on the company, you don't have to finance the whole thing yourself. There are banks who will be interested in lending to this market. Bank of Montreal, for example, has a $6 billion book of loans to American ESOPs, right, and are very much looking to be active here in Canada. The financing that I'm involved with, so Social Capital Partners partnered with the Healthcare of Ontario Pension Plan to finance the sale of Taylor guitars to their 1,400 workers. And the two former owners, Bob Taylor and Kurt Listog, are vendor financing part of that transaction and remain very much engaged in the company as they delever. I assume the same thing will be true here in Canada.
So the bank, if the bank is going to be part of the financing solution, are they more typically looking at kind of a conventional financing, like looking at the tangible assets within the business as sort of a basis for what they're willing to lend, or do you know?
They're open to cash flow lending. Like they're not. I don't think you will see banks lending in this market at the same level that they might lend to a private equity transaction, right?
Right.
But they will they'll lend based on the available. They'll look at it like a regular commercial loan, right?
And because of the trust ownership structure, I mean, there's no personal guarantees that are going to be available here, right? Because all
That's right.
the owners are kind of behind that firewall of the
Yeah,
trust.
yeah. So and it's the same with the private equity company where there's no personal guarantees involved there either. So it's
Okay.
I think we'll see banks, I think, be conservative in terms of the amount of leverage they're able to provide, but enough that the owner is going to get some amount of money up front if the company itself lends itself to being lends itself to bank financing. Not every company will. So in the UK, for example, over 90% of the transactions in the UK are entirely vendor financed. In the
Okay.
US, it's a lower percentage. Banks are more engaged. We'll see. My guess here in Canada, it will be somewhere in the middle.
Okay. So you mentioned a $10 million company. How small do you think the companies could get to still be able to
Yeah.
participate and take advantage of this?
I mean, we like to talk about it in terms of employee size, right? Because
Mhm.
the more employees you have, the more infrastructure you usually have. We generally guide folks to 25 employees is kind of the minimum you'd want to be in order to consider this. And you can go as high as you want, but what we see in the US and the UK is the range tends to be somewhere between 25 and 200. That's the typical employee size.
Well, my next question is going to be about leadership and governance, but I think this
Yeah.
is in part why you're saying a certain level of employee count, because I would imagine in most owner managed businesses, if that owner departs, then there could be a vacuum of leadership there, right? Is this what drives this employee, the headcount sort of metric?
Yeah. So there's no requirement that the owner leave the company. In fact, in a lot of cases, the owner
Okay.
will stay and continue to run it even during part of the period in which the company is deleveraging. It's their money, so that there's a reason to do that. You probably want to have a transition plan in place, though, right? So maybe stepping back and saying what makes a good company for this, right? And so I've kind of talked about the employee size. You'd be looking for companies that are in mature industries with strong and stable cash flow, so you can be pretty secure about the ability to deleverage. And you're looking for companies that have a thoughtful transition plan in place. They've either transitioned management over to a new group, or they have a plan to transition management, and they're going to stay on for a period of time. the selling owner, even though they can't control the board or the trustee board after the transaction, can take up to 40% of the shares or 40% of the votes of both the corporate board and the trustee board. So continue to influence the company after their departure in order to make sure that everything's on track with deleveraging and with the legacy that they're trying to maintain. So those are the types of companies. And then from an owner perspective, just briefly, what I've seen in my engagement in the US and the UK is that the owners who tend to choose this path choose it because they are really worried about what will happen if they sell to an outsider.
Right. It doesn't really seem like it lends itself to a clear-cut break and, seller now departs kind of thing.
That's right.
It's okay. So you mentioned how the workers can become owners through this trust structure without necessarily contributing any money on their own to like buy shares or whatnot. How is the company ownership divvied up
Yeah,
amongst the workers? Can you talk a little bit about how what sort of system or planning or thought goes into that?
for sure. And it's different in the UK and Canada, where it's reasonably simple between the UK and Canada, different in the US. But if you take the Canadian example, the shares will be owned 100% by, in this case, it needs to be at least 51%, but it's easiest to talk about it if it's 100%. So 100% owned by the trust. The trust then allocates benefits based on a formula, right? So let's say they want to pay out a dividend, right? We've got some excess cash, we're going to pay out a dividend. There'll be a formula in which that dividend is allocated among employees, and it can be based on wages or tenure or hours worked or any combination of those things. So it's quite common for dividends, if they're being paid annual, to be allocated based on wages. So if I make $100,000 a year, I'm going to get twice as much as someone who makes $50,000 a year.
And this is because trusts, don't like have ownership like shareholders; they have beneficiaries.
That's right.
So you create this formula that says this is how the benefits of this trust are distributed. So employees that come and go, it's not like an employee who's part of this for 10 years and gains some of the benefit of being part of the trust. If they quit or leave or move on, it's not like they somehow get to sell their interest in the trust. The trust owns the business, and then it's just reformulated every so often based upon these rules that are established.
So the answer is,
or do I have that right?
So it's partly right. That's true in the UK, right? So that is how it works in the UK. In Canada, you'll be able to choose between a profit sharing based or dividend based approach, or a capital based approach, or some combination of the two. So for it's complicated but super flexible, right? So I think a lot of people will just do exactly what you said, right? So they'll pay out dividends every so often. If you leave, you leave with nothing. In the US, the way it works is people accumulate rights to units in the trust over time. And when they leave, those units are converted to shares that they do sell back to the company. That's the way you benefit in the US. So you're benefiting from the growth of the equity value in the company there, very different from the UK. In Canada, it's a bit of a choose your own adventure. You can do either one or both. And part of the value of the capital side of it is in the event that the company is sold, right? You probably don't want to use the same formula that says if I make $100,000, I get twice as much as the person who makes $50,000, because the person who makes $50,000 might have been there for 30 years. And you want them to be rewarded for their tenure in the event of a big capital outcome like a company sale. And so the Canadian structure allows you to have a different formula if you're paying people out using capital that rewards tenure, which we think is super important. So if you imagine that scenario I just said, that $50,000 employee is going to get a lot more than a $100,000 employee who joined, last year.
So you said some of these are underway that are likely maybe going to close at the end of the year or the beginning of 2025. And I'm sure you've had some conversations with some of these people. You're familiar with these deals. So I mean, I don't want you to give us any specifics, but what you're describing sounds like it could be quite complex. Can you give us an idea of what sort of the deal friction with respect to advisory and fees and all that might look like for doing one of these things?
So I view it as similarly complex to selling to private equity, having sold to private equity. right? So I've had businesses that I've sold to private equity. We've gone through the whole process of, you have to figure out who you're going to sell it to. There's the quality of earnings. There are very complicated shareholders agreements. There are warranties you need to worry about. If you're going to sell your business, it's going to be complicated unless you're passing it on to your family. And the EOT is a different type of complexity to selling it to an outsider, but not more complicated. The fees are for sure going to be lower, right, than if you're selling it to private equity, where you are paying a agent to sell it for you. We don't know yet how the fees are going to land long term in Canada. In the UK, it's sort of $50,000 ish. I think it'll be more than that in Canada because it's slightly more complicated here. But again, if you're comparing it to like a 2 or 3%, it'll be less than that, right? Or at least I believe it will be less than that. You're not who you're working with is likely some sort of advisor to guide you through the process, and your lawyer and your accountant. Those are but there's no counterparty that you need to worry about as well in these transactions. Does that make sense? So yeah, complex.
It does. It also seems like a lot of these fees are maybe just going to be paid for by the entity at
Yes,
some
that's
point
right.
along this journey, right?
Yeah,
So traditionally when there's a transaction, both parties are kind of thinking about it like as additions or subtractions. The seller's thinking, I'm selling for $1 million, but then I have to pay these people these fees to help me. The
yeah.
buyers similarly are saying, I'm going to pay $1 million, but then I also have to pay these advisors to help me. Whereas a lot of these fees are just going to be internalized within the operation of the business that may not affect the transaction price, I guess, from the point of view of the seller.
100%, right? So if I'm committed to this process, right, and this is what I'm going to do. I'm going to sell to an EOT. Then the advisory costs are going to be paid for by the business, and I'll get my whatever I get at the end of the day. There's no success fee, right? I'm not taking 1% of that or 2% of that and giving it to someone else. Or at least I haven't heard of anyone doing this based on success fees.
Yeah. Okay. So,
and
the
other thing about it is it's controllable, right? So as the owner, I control the pace, the timing, I control all of the aspects of this, right? There's no one else who I need to worry about who is going to be forcing deadlines or slowing things down. It's entirely under my control as the owner.
Okay. Do you think there's a certain kind or characteristic of a business that's best suited to this?
I do, and I think we talked about that a little bit before. But it's not good for startups, right? It's not good if you're consistently having to invest new money into capital in the business, right? Businesses that are well suited to deleveraging, right? So where the price is not going to be astronomical, right? If your fair market value of your business is 10 times EBITDA, it's probably not a great idea, right? If the fair market value of your business is 6 times EBITDA or less, the deleveraging is probably manageable as long as you have strong and stable cash flows. So you just want to think about the structure of your business. And look, the industries where this has worked or that are using this a lot in the US and the UK tend to be construction, wholesaling, distribution, light manufacturing, professional services. These are not super high valuation companies, but with strong and stable cash flows and owners who are very people and community focused.
What are the potential downsides for employees?
Well, there's no real downsides for employees. I mean, they're not paying anything for their shares. As long as there's a thoughtful transition plan, and as long as the deal is, well designed, right? Like if an owner, employees are exposed in the same way they're exposed whenever an owner leaves a company, right? So if an owner is intending to leave, then the next manager is going to be really important. The nice thing about the EOT is the incentives of the shareholders are now very aligned with the workers, right? Which is why these companies,
totally,
right? Like these companies tend not to lay off as many people in recessions because they're not worried about maintaining EBITDA so they can sell the company right after the recession. And as a result, they tend to outperform coming out of downturns, right? They tend to bankrupt far less often than companies that are owned in other ways. So it's almost entirely upside for employees unless the owner sells the business to someone who can't run it. but that's always a risk in any business transition. Oh, sorry, transition to the company to someone who can't run it and doesn't.
Okay. Do you foresee these new rules creating more competition from outside buyers? Do you think that there are some sellers who maybe are on the fence that might be swayed by some of the tax benefits, for example, to head down this route versus another?
Sure. I mean, I think there will be situations where an owner will say to an outside buyer, "Hey, I've got this new option now. You got to pay me more to buy the business." So I think that will happen in some situations because of the tax advantage. I think in other situations, owners who think they have no choice, right, will look to this as an option instead. I mean, there's a lot of business owners who get to be whatever, 65, 70, 75, haven't really thought about this, put it off. And when they get to the point where they really want to sell, feel like they can only sell to their competitor or to some outside investor. And some of those will find this to be a much more appealing option.
Now, correct me if I'm wrong, but when this legislation was introduced earlier this year, I believe there's some kind of sort of sunset or horizon on some of these rules. Can you talk a little bit about that and what the motivation might be from the government's point of view of creating that?
For sure. Well, there's only one of the rules that sunsets, and that's the tax incentive. So the tax incentive, as currently drafted, will expire at the end of 2026. So all deals that are completed by the end of 2026 will qualify for the tax incentive, no matter when your money actually comes in. So, our understanding is that the reason for the expiry of the tax incentive was budgetary, right? So there was a concern that, at the time, which was, last year, that there wasn't enough budget room to pay for like a long-term tax incentive. Our view, and I think the view of government, I think the view of even opposition parties, is that this is a very good policy that they want to support long term. So our strong belief is that it will be extended and made permanent at some point before its expiry. But for now, if this is something you're interested in and you're really sure that this is a path you want to go down, you may want to consider starting to look at it pretty soon.
It almost seems like they're tentatively wondering if there's something they've left out or something they haven't thought of. So they're kind of creating this time horizon so they can examine some of these cases before they make their next decision. I mean,
it's possible. I mean, certainly that there are elements of the structure that are going to be changed over time because we didn't think about certain things. But the UK has been doing this for 10 years. The UK, there is no limitation on the tax incentive. So if I sell my company to an EOT in the UK, I pay no capital gains tax no matter how big it is, right? And I've read reports on some like one company in particular that had £107 million capital gains tax that they didn't have to pay because they sold to an EOT. And they just had a massive budget review in the UK and didn't change this incentive after 10 years, knowing how big it can be. So, I think there's very little evidence, and their structure, again, like I say, is quite similar to ours. So it seems like there's very little evidence to support the idea that they'll ever want to shut it down, right? Because the outcomes are so good. And I think it's worth talking about the outcomes. Like, from a politician's perspective, right? The outcomes of employee ownership that have been proven in the US and the UK, you can't beat them, right? It keeps companies Canadian, right? It keeps them in their local communities. It's, like I say, better in recession. It has demonstrable impact on employee wealth and employee take-home wages, right? All of these things that are super important, that we're, better in productivity, better in growth. So all of these things are things that politicians are caring about right now. So it's hard to imagine them saying, this thing that is a great idea that's working in other countries that's now here in Canada, we're just going to shut it down. Feels very unlikely.
We have someone here from the UK. Victor from the UK says he just gave the video a like. Thank you very much, Victor. And please, if you're enjoying it, give it a like, give it a share, leave a comment. But he follows up with another question. And he says, is it possible that post-sale, the company could be controlled by the previous owner if they hold a large enough shareholding? How might this affect the tax situation? So maybe we can double back on that because you mentioned that earlier.
Yeah.
You said that the current owner could retain part of the ownership or have a very heavy hand in the leadership of the trust. Can we talk about that a little bit more? Can you circle back on that?
For sure. And interestingly, Victor, in the UK, they've actually just changed the rules to make them more similar to the Canadian rules, which prevents what you've just described. So when I sell to an EOT, the only way to do it is by selling 51% of the or 50% or more of the shares. So I have to sell a controlling interest. Otherwise, it's
The
not a
trust.
qualified transaction, and I don't get the tax incentive. So the most an owner can do is hold a strong minority. So call it 49.9% or whatever. They can hold 40% of the votes on both of the boards, the trustee board and the company board, but that's it. And if at any point it looks to an outsider like the CRA or the Treasury in the UK that I am retaining control as the owner, then I can disqualify the transaction and claw back the tax incentive. So there's risk to an owner of doing this in a way that is not appropriate.
Okay, so someone who might look at this as a way to gain a huge tax advantage for themselves while still kind of like steering the ship.
No.
This really has to be about a transition, and they really should think about, even if they do take this strong minority position, it really is more of a coaching and guidance kind of role, right?
Yeah,
I guess that makes sense too from the point of view of success long term of the enterprise, is just to have that availability of the experienced person there with big interest in making sure it works.
Yeah, it's great. And look, I think in a lot of cases, the owner, if they're still running the company, might still stay and run the company, and that's okay. They just are now reporting to a board that they don't control, right? So they can be fired if they do a bad job on behalf of the majority shareholders who are now the employees. So I think there's going to be all sorts of forms of this, but there are lots of rules that prevent the type of fraud, I would say, that we might worry about here, and that was very important to us. I mean, the last thing we wanted this to be was some tax break that you can use to avoid taxes without actually transferring benefits or control over to this trust on behalf of workers. So a lot of work has been done, and look, there's lots of pre-existing clauses in the Income Tax Act here in Canada that prevent that kind of thing. They've all been applied for the purposes of this employee ownership trust.
Do you think there's a way for someone who wants to buy a business to make some kind of plan involving these rules when presenting to a seller? For example, saying, hey, you could hire me to become your VP. I will then go through with the EOT plan. And maybe that searcher, gives themselves a significant outlay of the capital or royalties, but uses this as sort of an enhancement or a game plan to make an attractive pitch to someone who wants to retire.
Maybe. I mean, so you could see a scenario where an owner sells 40% to call it a searcher, or 25% to a searcher, and the rest of it to the EOT. And then that company can go on with that type of shareholding. And in fact, it's interesting, right? Because part of the problem with the search fund market or entrepreneurship through acquisition is the demands of the investor, right? So I'm a searcher. I go to buy this company. I identify a great one. I buy it. But I've got an investor who is looking for a 30% IRR over 5 years. I'm going to have to sell this company in 5 years, right? Like there's a very similar to private equity. It drives relatively quick sales. I've never actually really thought about this, David, but it's an interesting idea, because the searcher can instead say, look, I've identified this business and I like it. I like the community. I like what it does. I'm passionate about the idea. I want to do this for 20 years. So instead of using an outside investor, right, to help me buy the company, I can use, I can tell the owner, why don't we use an EOT? And so the owner then gets paid, essentially vendor finances it on behalf of their workers. This new person comes in as a thoughtful transition for the company in a case where it's appropriate. And then, that can exist forever, right? And then the benefits are shared between the searcher and the workers.
In essence, it's a kind of a combination between a seller financing with patient capital on the part of the employees being the controlling block of that, sitting behind that seller note. So if you're tuned in and you want to take advantage of that idea, let me know as soon as you do your deal, because I'll have you on the show, viewer, and we'll invite Jon back and you can tell your story and we can see how it works.
I would love that.
I'm conscious of your time. I know you have another engagement that starts very shortly here. But I want to thank you because like it's a new kind of thing. And whenever we have something new, I mean, as we've just been talking here, we've been kind of spitballing these different ideas about how someone might use these rules for one person's point of view or another person's, advantage or whatever. And I think that the creativity that comes out of this stuff is never fully appreciated before it's let loose.
Yeah.
And I'm looking forward to seeing what kinds of things may happen.
Look, I think that's really well said. I think there are, like, even on this call, we've thought of things, or you have anyway, that I think are really interesting. And, I think we've done a pretty good job, or the government's done a pretty good job of protecting against fraud, which leaves open opportunities for creative and useful structures, right, using this approach. And that, I think, is really exciting. So I'm really optimistic about where it goes. It is, we have a website that we've put together around awareness on this. It's employee-ownership.ca. If anyone's interested, it is like, it's a nonprofit. Its purpose is just to provide information. We're going to be constantly updating it. So you should go on there and sign up just to continue to learn about this stuff as we go. But, we're really optimistic about what this might mean for the Canadian economy and for what it might mean for Canadian workers long term.
Awesome. I'm going to put a link to that in the show notes once our live stream is over. For anyone who's listening later, you can find it down below. You also mentioned at the beginning of the show a leveraged buyout, and I'm going to put a link to a video I made a few years ago, which references that, and I'll put that in notes as well for people that are watching. And I'll put your LinkedIn profile URL. Is that all right, John?
Perfect.
Awesome. Well, thank you so much for joining the show today. It's been great to have you. Thanks everyone for coming and joining us live. Thanks, Victor, for your question.
Thanks,
And
Victor.
I'll look forward to all the comments left down below. And let us know if you are viewing this today and you've been a part of one of these types of deals in the UK, or you're part of an ESOP in the US. Share your experience. Let other people know what it was like for you as an employee, or someone who worked in management, maybe in one of these firms, and how things change for the positive or negative. It's going to be really interesting for people to be able to see and share from your experience. And with that, I'll say thanks, John. And
Thanks,
to
David.
everyone else, we'll see you next time.
Bye-bye.
So, how can you learn more about buying, selling, financing, and managing small and medium-sized businesses? Easy. Go over to my blog site, davidcbarnett.com, where you can learn more about me and how I work with my clients. You can learn more about my books and courses that I prepared for you. You can find out how to subscribe to my email list, the YouTube playlists, and more. There's literally hundreds of hours of content there, all for free, and I'd love for you to be my guest. Special thanks go to Mark Willis at Lake Growth Financial, today's video sponsor. Mark helps people better manage their personal and business finances through the Bank on Yourself insurance strategy. This is something I've done personally and I've seen others use it successfully for years. Go to newbankingsolution.com to find all the interviews I've done with Mark and learn more about the advantages of these programs. While there, sign up for a free consultation to learn what this solution might look like for you.